I'm Frankie, and today we're going to talk a little bit about how to protect your retirement nest egg from downside volatility and from the market crashes in general. We've seen over the past few years, the market can be volatile. It's not something that's just always going to go up in a straight line. There are lots of ups and downs, and we need to be able to protect ourselves in retirement. The first thing that we have to do is we have to assess what is our risk score. Where do we feel comfortable when it comes to risk? What is your comfort level with the stock market? This isn't the same for everybody. Some people feel in a situation, well, I really don't want to take a lot of risk. The markets have crashed in the past, and I just can't stomach that. I just don't feel comfortable. Other people have been through those market crashes. They know that it's a little bit stressful, but they understand that, well, the markets come back up, and over time, I want to try to get a better rate of return, so I'm okay taking a higher level of risk. So it's important to determine your risk score, and that's something we can do through questions. We have questionnaires and trying to figure out that if the stock market crashes by 50%, what's the most you can tolerate going down? So having the answer to that question helps us set up your portfolio so that you don't lose more money than you feel comfortable with. So that's something that we look at, is how to set it up so that if the markets crash 50% and you don't want to lose more than 20%, that we set up the portfolio accordingly. If that answer is 20%, then we have 60% of the money in a safe position and only 40% in the market. This way, if the market goes down by 50%, that 40% only goes down to 20%, and this side doesn't lose any of the money. So it keeps your portfolio protected, keeps you in a position where you don't ever lose more than you feel comfortable with, and it protects a portion of that retirement nest egg. Thanks for listening in. If you like what you hear, please feel free to hit the like button below or subscribe for more content. You'll be getting videos like this anytime you like. Now, back to the video. The next strategy we can use to protect our savings from market risk and market volatility is really just building an understanding, getting an education on the way that markets work. It's important to understand that the markets are not just going to continue to go up. They don't go up in a straight line, and that there's a lot of volatility. This is something that we've seen in history. From 2000 to today, the stock market has had 3 market declines of 20% or more. In the year 2000, 2001, 2002, the stock market went down by 50%. In the year 2008, the stock market went down by 50%. In the year 2022, the stock market went down over 20%. So this is something that we've seen several times over the past 25 years. And we need to make sure that we understand that that's likely going to continue in the future. There are going to be these major market crashes. Now, it's also important to understand stage of life investing. So when you are investing money, it matters. When you are saving money, it matters. And the level of risk that you're taking needs to coincide in part with where you are at when it comes to your retirement and when it comes to how close you are to retirement. And so if you are in a position that you're closer to retirement, you probably should take less risk than if you were further away from retirement. So if you're in your 20s, your 30s, your 40s, you're in a position that you are saving money. You're in your accumulation stage of life, accumulating funds into your retirement accounts. And during that time period, it's okay to have market crashes. And the market crashes, it typically has always rebounded. And so if you're in that situation, you continue saving and it ends up very well for you. Now, there's some other folks who are closer to retirement, those pre-retirees, those retirees. And when you're in that situation, when you're, late 50s, early 60s, late 60s, 70s, things like that, you really are more on a defensive position because you don't want to ride the waves, because you're more in a distribution phase, whereas you're not accumulating funds, but you are distributing funds from those retirement accounts. So you really need to be more conservative and not be in a position where you're riding the waves of the stock market with your entire investment portfolio. The third strategy that we can use to protect our hard-earned principal from volatility and from the market crashes is to really rebalance your portfolio and make sure that it's properly allocated. So when you look at your portfolio, if you don't know the level of risk associated with it, you really want to find that out. You want to know, what does it look like? What happens if the market crashes like it did in 2008? And then you want to rebalance and reallocate it so that it's within your risk tolerance and that it's able to perform at the level that you need it to. So going off the example we had earlier, if you have a 20% risk tolerance, if you don't want to ever lose more than 20% when the stock market crashes, you really shouldn't have more than 40% of your money at risk in the market. Why? Because if the stock market crashes by 50%, and let's say, for instance, you have half of the money, 50% of the money in the market, 50% of the money safe. Now, if the stock market goes down, you go down as much as 25%, which is more than your 20% threshold. So if you're in that situation, you set it up so you have 40% on the market, 60% in a safe money investment. Now, as far as the market investments go, there's several different ones out there. There's ETFs, there's mutual funds, there's stocks, there's bonds, there's options. There's a lot of different options out there. So what we use here is we use ETFs. So you're diversifying the investments and getting a whole spread of a lot of different stocks all across the country. Now, on the other side, on the safe side, we look into a bunch of different options. There's a whole lot of safe money investments out there. There's CDs, savings accounts, money markets, treasuries, there's fixed annuities, and there's fixed indexed annuities. We tend to use the fixed indexed annuities because they provide the highest rate of return for investments that have no market risk. So when we set up a portfolio and balance it, that is what we're looking to do. Now, what if after we set up the portfolio a few years down the road, the market does really well? Well, then you could rebalance the portfolio by shifting some of those market gains into the annuity side. Same thing if it goes the other way. If the market does really poorly, you can shift some of those funds from the annuity side into the market account and rebalance the portfolio that way as well. So these are some of the strategies that you can use to protect yourself from market volatility over the course of your retirement years.